All right, reporting and interpreting cost of sales and inventory. So you guys have seen this basically since day one, right? We carry inventory, we're ePhone, we produce some inventory, we carry it on our books based on the cost that we'd put into it. When we sell it, we recognize revenue, and the cost moves from inventory to expense, right, to cost of goods sold. We haven't yet covered until today how you determine what the amount of that cost of goods sold actually is. You've always been told, you've said the inventory costs $2,000 to produce, right? So now we're going into how do you actually calculate that number. So this is kind of macro. Oh, sorry about that. So this is macro, high level. What are some roles of the accounting system? We want it to provide accurate information, up-to-date information, and information to help protect assets. So that's the accounting system. How about inventory management? So inventory management is interesting because you want to have enough inventory on hand to meet your expected demand, but carrying inventory is very costly, so you don't want to have too much. So the question is, how do you figure out how much inventory you need? Walmart is famous for pioneering what's called a just-in-time inventory system, which is where they were able to figure out exactly how much inventory they needed, and they would have that exact amount shipped to their location, and they would sell it all very quickly, and they would never have an instance where the customer would go to the store and want to buy something and wouldn't be able to because that's a lost sale. But they'd also never have a case where they were carrying shelves and shelves worth of a product that no one was buying, right? So they were able to manage their inventory very well. So we don't get into that in financial accounting, but you can understand what the balance is, right? You can't just buy a million ePhones to carry in stock if you only think the demand is going to be 200,000, right? But you want to be able to make a sale if a customer walks in the door. So the definition of inventory, the technical definition, is it's tangible property, meaning you can touch it and feel it, as opposed to intangible, held for sale in the normal course of business. How is that different than selling a piece of equipment that we no longer need? And I've said this a few times already. We're not in the business of selling equipment, we're in the business of selling phones. Normal course of business is selling phones, right? That's why you don't see equipment carried as inventory, because equipment isn't held for sale in the normal course of business. And it's used to produce goods or services. So the next slide here, we'll come back to these types of inventory, but imagine, for example, if we are a manufacturer. So what are our processes? We have to buy raw goods, we have to process the raw goods, and then we have a finished product, right? But at each stage, we have a different classification. The raw materials might be, let's say we buy the copper to make the microchips, right? That's a raw material. Until we have a finished phone, it's basically work in process. From 1% complete to 99% complete, we'll consider it work in process. That's everything from assembling the microchip to putting it all together, to putting the glass on top, to putting the case on, to putting it in the packaging, and then it's ready to go, right? So it's important to understand where the inventory is in its life cycle. Merchandise inventory. So this would apply if we are a manufacturer. Okay. Merchandise inventory applies if you are a retailer. Walmart does not manufacture anything. They just buy finished goods from other companies and resell them at a higher price, right? So there's different types of inventory depending on what your business operations are. So how do we determine what costs are included in inventory purchases? Now I want you to think of this as if we spend a certain amount, we have to determine what the debits are. Is the debit all to inventory, or is there inventory and expense, right? So remember, debits can be an increase in assets or an increase in expenses. We know what our credit is. Our credit will be accounts payable or cash. So the cost principle requires that inventory is to be recorded at the price paid or the consideration given. You also have to include all costs incurred to bring the asset to usable or saleable condition. So the invoice price, of course, that's what you will have, you would have paid for 100 phones if you were Walmart, right? Freight, that's transportation. Inspection, you might pay a third-party firm to inspect a sample of the phones to make sure that you're getting what you ordered, or you might have employees who do that for you. And then preparation costs, so maybe costs to get it onto the shelf, or maybe you need to process it a little bit more to get it ready for sale. All of these costs are included in the value of inventory. They're not expensed immediately. So that's the key consideration here. Where does the debit go? Does it go to inventory, or does it go to an expense immediately? So this is an expansion of what we had just discussed. If you're a merchandiser, your inventory operations are relatively straightforward in that you purchase merchandise, which is an asset, they sit in inventory, and when you sell them, they become a cost of sale, right? If you're a manufacturer, there's a lot more that goes into it, because you have to acquire the raw materials, and those form your raw materials inventory, but then you have to put in some work to get them from raw materials to finished goods. So work in process, also called WIP, okay? Not only is it made up of raw materials, but you also have direct labor. Direct labor is employees who might be standing on the factory line, physically assembling the phones if you don't have a robot doing it. And factory overhead. So you might have heard this term overhead. Overhead is all the fixed costs that a business incurs in its manufacturing operations. So overhead might include the cost of a manufacturing warehouse that you're renting, all the utilities, right? You might need a foreman on the warehouse floor walking around and making sure that everything is being built to code or whatnot. So that's different than corporate overhead. If we have 4 manufacturing facilities and we have a head office, the cost of those manufacturing facilities will be capitalized in inventory. The cost of the head office will not, because the head office is not considered factory overhead. Okay, it's considered corporate overhead. So corporate overhead gets expensed as incurred. Factory overhead gets capitalized, or the debit goes to work in process inventory, meaning it sits on the balance sheet. So again, this is all about expense recognition. Either way, we're paying money, right? Either way, cash is leaving the company. It's just, is it inventory, is it an asset, or is it an expense? And then all the WIP should eventually become finished goods. And that's a phone that we can actually sell. And then once we sell it to Walmart, it becomes a cost of sale. Okay. So if you think about the total amount of inventory that we have on hand that could be sold, or goods available for sale, it's a function of beginning inventory, what we had at January 1st, plus what we purchased for the period, and I'll actually add, or produced, right? This is not revolutionary here. If we, and I'll use bricks as an example because I used to audit a brick maker, but if we had 1,000 bricks sitting in the yard at the beginning of the year, and we purchased or produced another 1,000 bricks, we have a potential to sell 2,000 bricks, right? Now, whatever we sell will move to cost of sales, right? Cost of goods sold, sometimes, on the income statement. Whatever we don't sell will sit in ending inventory. So we have beginning inventory, purchases or production, and then ending inventory. So you can think of it as, there's a better slide actually that'll show this, but so again, all of the beginning goods plus what we produce or buy form a pool, a common pool, and the question is, how much do we have left over at the end of the year versus how much was sold, okay? Now it seems like a pretty simple question, but it has a complex answer. So what are some, we talked about internal controls, I think, of cash. That's why we have a bank reconciliation, to make sure that people aren't writing checks to themselves. But you can imagine if you are a manufacturer of high-end phones, that phones are pretty easy to steal, right? So how do you make sure that your employees don't walk out the door with them? Separation of inventory accounting and physical handling. So that means that the people who are responsible for packing the box that goes out the door don't also have access to the system. That's how you'll catch a discrepancy, right? If someone is taking phones for themselves and the accounting system says you should have 100 phones, we only have 80 phones in inventory, we'll realize there's a problem. A smart person might take 20 phones for themselves and say, oh, we sold 20 more phones or we shipped 20 more phones, and then make sure that the inventory system matches what the physical count would show, right? Limiting access. You might need a pass card to get into the warehouse so that random people can't walk in. Storage in a manner that protects from theft and damage. So of course you don't want the phone sitting outside. That's just common sense. Maintaining perpetual inventory records. We're going to get into that, but you want to make sure that your inventory is very up to date, right? Every day you want to know exactly how many phones you have. You don't want to wait 6 months to do an inventory count and realize you're short by 20% or 30%. And then a comparison of your record, of the perpetual record, to physical counts. So when you're an auditor, you actually go and physically count inventory at year end, usually December 31st. And I'm not exaggerating when I say physically count. You show up to the warehouse after hours on December 31st, and you count that there's 100 boxes, and you make sure that you take a sample and you say, well, each box has 10 phones in it, therefore we have 1,000 phones. So I use the example of a brick manufacturer because where do you think they store their bricks? It's basically outdoors in like a giant covered shed, but there's no insulation, there's no heating. So I was out there, I think January 1st or January 2nd to count bricks. And it was like a blizzard, it was like minus 20 degrees. It took like 3 or 4 hours of counting. And I couldn't drive home because I couldn't feel my feet. So it took me like 30 minutes of sitting in the car for my feet to warm up before I could even like feel the pedals and drive away. So this is an actual thing. Inventory counts are a big deal. They usually happen at really bad times. It's like New Year's or just after New Year's. You have to be there first thing in the morning or really late at night because you can't be doing it when they're actually operating. But these physical inventory counts are a big deal. You need to make sure that everything is accounted for properly. All right, so there's 2 types of inventory systems. One is called perpetual, and the word perpetual just means continuous. And the other is periodic. Periodic, as the name would imply, is where you only count inventory, or you only account for inventory over a specific period of time, every quarter or sometimes every year. So a perpetual system provides up-to-date inventory records. That means at the end of every day, because our accounting system reflects the transactions for that day, you know exactly how much inventory you'll have. A periodic system actually doesn't keep track of all the inventory you're selling. You only update it when you do a physical count, and you can imply the difference. You know that if you started with 100 phones and you purchased 20 phones, you should have 120. You actually only have 40. You know by definition you sold 80. That's how the periodic system works. It implies the number of goods that were sold. Whereas a perpetual system will record a sale of a phone, or rather the cost of goods sold for the phone every time a sale is made. And it'll say you sold one phone, and it'll show that 80 times. Either way, you'll get to the same thing. It's just how the system works. So this shows the comparisons between how inventory is accounted for under each system. So in either case, perpetual or periodic, beginning inventory is carried over from the prior period, right? You have purchases. Now, under a perpetual system, your purchases are debited to inventory. And that's what we're used to seeing, right? That's what you've seen since day one. Under the periodic system, the purchases are accumulated in what's called a purchases account. And this is a temporary account. meaning you'll never see this on the financials. It's just a placeholder, okay? That will total your cost of goods available for sale. Then you're going to have ending inventory. In this case, your ending inventory, you know what it should be because you've been recording the cost of goods sold for every time you make a sale. Under the periodic system, the only way you'll know is when you do a physical inventory count at the end of the period, okay? And then your cost of sales is just the value of the inventory, right? The entry to record cost of sales is debit COGS, credit inventory under a perpetual system. Under a periodic system, it's computed as a residual amount at the end of the period. So that's what I was saying, how you can determine, you can imply, if you know you had cost of goods available for sale of $100 and the value of your inventory is now only $20, you know by definition you sold $80 worth, okay? So one thing I do want to say is, even in perpetual systems, so it becomes, periodic systems were around because we didn't have computers or computing power was limited and it was almost impossible to do a manual inventory count every day. So companies would often just say, we'll just count it every 2 weeks or every month or something. Of course, with RFID and the use of computers, like Amazon's inventory system is all perpetual and it's all online in real time, right? You can now, like if you go to a store and they say, oh, we don't have this item, but the location up the street does have the item because they have access to these online records. So periodic is becoming less and less relevant. Perpetual is much more the case now that computing power is so cheap. But even under perpetual systems, they still do inventory counts frequently. A, to make sure they're accounting for everything correctly, and B, to make sure there's no theft, right? So inventory counts are still a very real thing. We just don't need them to get cost of goods sold as we're not as heavily reliant on them as we once were. So this is journal entries under each scenario. To be honest, I'm not going to test you on these, so I'm not going to spend a lot of time on it. I just want you to understand that there's two systems. They ultimately will get you to the same thing. You'll get to the same cost of goods sold. It's just how you get there. And it's really just a little accounting trickery that gets you there. But I'm not too concerned with, I won't be testing you on journal entries for periodic versus perpetual, okay? Because I think it's not relevant these days. Methods for estimating inventory. So here's an example where a client goes to their accountant and they say, I use a periodic inventory method. Can you help me estimate inventory? So they have beginning inventory and they know what their purchases are. And gross margin is 30%. So how companies sometimes price their goods is cost plus. So they know that if we're buying a phone for $100, we'll charge 20% above that. So we'll sell it for $120, therefore your gross margin is, well actually the math is a little bit more complex, but they work backwards to assume a gross margin. Gross margin is just your, and I'll show you the calculation in a second, is just your sales minus cost of goods sold gives you, so if you have sales of 100, cost of goods sold of 80, that'll give you gross profit of 20. Your gross margin is going to be 20%. Now, if you go cost plus, if you start with 80, 80 plus 20% will get you 96. So it's actually 80 divided by, I think, 0.8. It's 80 divided by 1 minus your target gross margin. It's just how the arithmetic works. So in this example, if sales were 200 grand, beginning inventory was 4,500, and purchases were 150 grand. Okay, so again, this is, sales are always going to be 100%. Cost of sales are 70% such that gross margin is 30%. We were given sales, we were given beginning inventory, we were given purchases. So we know that cost of goods available for sale is 154, right? We started with 4,500, we purchased 150 grand. If we didn't sell anything, our inventory account on the financial statements would be 154,500, right? But we don't really know the ending inventory. We haven't done an inventory count. But we know that our pricing system is such that our gross margin is 30%, right? So we know that gross margin has to be 30% of 200 grand, which is 60, right? Which is how they get this. And therefore, your cost of sales has to be 140. Remember that chart that showed how the pool of cost of goods available for sale is split? the debit has to either be in inventory or cost of goods sold. Well, we know that 140 grand is sitting in cost of goods sold, therefore the remainder has to be in inventory. Notice how the sum of the ending inventory plus the cost of sales is equal to the cost of goods available for sale, right? Now, realistically, I think we would say, well, let's do an inventory count and confirm that your ending inventory is 14,500. But it's a quick sort of check. You can mentally figure out exactly how much they should have, right? Okay, so all that being said, even with great perpetual systems, and maybe Amazon doesn't have this problem, but if you're a small business or if you have old computer systems, it's very possible that you have errors in inventory. And you can quickly see how if you have 10 warehouses across the country and there's goods moving in and out and you have 100 different types of product moving in and out and you don't have the best computer system and sometimes your employees are a bit sloppy with how they handle things and account for things, you can imagine that there's probably errors in inventory. And by that I mean either they ship too much or they ship too little, or they broke things, or you never got delivered what you thought you got delivered, or at the year-end inventory count, there were mistakes made. Inventory counts, it's almost impossible sometimes to count every single unit, so you estimate. So you might look at a room like this and look at the volume of the room and say, well, these boxes fill the room and each box holds a certain number of phones, therefore we estimate we have about this many phones. But again, there's errors there, right? It's estimation. So again, computers have made things a lot easier and companies care very much about having accurate inventory records, but errors do occur. So the question is, how do errors in measuring inventory impact the financial statements? Okay, so this chart looks a little complicated, but I'll show you some practical examples with numbers to make it clear. But this is sort of a reference chart that you can use to figure out the directionality of effects. This certainly will be tested, so it's important that you understand how everything, what the logic is, okay? So we're going to show some examples. So there's 4 potential cases, assuming that your ending inventory and beginning inventory aren't completely accurate. Ending inventory can be overstated or understated. So what does it mean for ending inventory to be overstated? It means when you do the physical count and your accounting records show they match, they say you have 120 grand worth of inventory. You actually, if someone were to go in and actually count every individual item, you might only have 110,000. So on your books, your inventory balance is too high, okay? So, of course, I mean, this intersection here is basically ending inventory is overstated. Well, ending inventory plus meaning too high, okay? So before we go to retained earnings, let's see what effect that has on the cost of sales. Cost of sales is too low. Now, why is that the case? So think of how we can impute cost of sales. We can figure out that if we know what our total cost of goods available for sale are, less the amount of inventory we actually have, the difference goes to cost of sales. Notice how the goods available for sale, we're saying, is unchanged if our ending inventory is not, is overstated. So we know we should have a total of $200,000 to allocate. That's the total of our beginning inventory plus the purchases we made. We know that we have $200,000 that either has to belong to inventory or to cost of goods sold. If we overcount the inventory, that means that too much is allocated to inventory and therefore not enough is allocated to cost of sales, right? Meaning we didn't sell as much as we thought, or rather, we sold less than we actually did sell. We think we sold less than we actually did sell, okay? So if cost of sales is understated, how does that flow through the rest of the financial statements? Well, gross profit is, of course, overstated, right? And therefore, net earnings is overstated, and therefore, retained earnings is overstated. Okay? Now, if your ending inventory is the opposite, understated, meaning the actual amount is higher than what we're carrying on the books. The reverse is true. So if ending inventory is understated, that means, so if we were to do a physical count and we see there's 110,000, that hasn't changed. But if we were to go unit by unit, but we think that there's only 100 grand, okay? That means we think we sold more than we actually sold. So what happens there is our cost of sales is too high, meaning our gross profit is too low and our net earnings are too low, and therefore retained earnings is too low. Okay. So the opposite case is, or the kind of a mirrored case is errors in beginning inventory. So remember, we're talking about ending inventory here. Ending inventory has no impact on the cost of goods available for sale because the cost of goods available for sale is calculated as beginning inventory plus purchases, or what you produce throughout the year, right? In the case of beginning inventory, if beginning inventory is misstated, our cost of goods available for sale is going to be misstated. Notice how in the ending inventory case, these are both NA. We know what the total should be. If our beginning inventory is overstated, for example, let's say our beginning inventory was actually 5 grand, but we thought it was 10 grand, and then we take 10 grand and add purchases of 100 grand to it, we're going to think our cost of goods available for sale is 110 grand. It should actually be 105 grand, right? So the goods available for sale is overstated. So to the extent that we get our ending inventory calculation correct, right, that extra 5 grand, that overstatement in the beginning is going to get allocated to cost of sales. Because let's say at the end of the year, we actually have $20,000 of ending inventory. So if we had counted accurately and we knew that our cost of goods available for sale was actually 105 less 20 ending inventory means cost of goods sold is 95. In this case, if our ending inventory is still 20 grand, but we're starting from goods available for sale of 110 grand, now we're at, sorry, it was 85 in the first case. Now we're at 90 grand. So our cost of sales is 5 grand too high in that example. Now again, the effects on the income statement are the same. Gross profit is too low and net earnings are too low, and therefore retained earnings is too low. But again, an overstatement in beginning inventory has no impact on ending inventory, assuming that we count the ending inventory correctly. Okay? And again, there's the reverse case for if beginning inventory is understated. Well, we're going to understate our goods available for sale, meaning we're going to think we sold less than we actually did sell. So our cost of goods, so our cost of sales is going to be too low, and therefore the income statement effects are going to be the opposite. Gross profit is going to be too high, net earnings are going to be too high, retained earnings are going to be too high. So let's show some practical examples, okay? And hopefully you can understand the logic instead of just having to memorize this table. The other point to appreciate is that the ending inventory of one period becomes the beginning inventory of the next period, right? Let's assume this was 2015 and this was 2016. That makes sense, right? If we thought we had 1,000 bricks at December 31st, 2016, on January 1st, assuming we haven't built anything or produced anything, we're still going to have $1,000 of bricks, right? So the interesting thing here is these errors actually reverse themselves over time. Because you see here that if ending inventory was understated, you can see, and so here U is understated, O is overstated, NE is no effect. You can see the impact is cost of sales is overstated, and it's the opposite next year. And gross profit and net earnings are understated, and next year they're overstated. So this is just in case you want to see it in words, explained a different way. But it says basically everything that I've said up till now. It is very confusing. And I'll admit, when I took this course, I got this wrong, I remember, on my midterm, because I didn't, or on the final, because I didn't study. I'm like, oh, I don't know, like I'll just guess. Maybe it's overstated, maybe it's understated. So it is complex. It's not like, it's not easy stuff, because you have to think like, it's almost like a few flips, right? It's like, how many flips does it take till you get to the answer? And it's all like, it's almost binary, right? So it can be a little complex. So here's an example with numbers, so hopefully everybody can understand, because I've been throwing out numbers here, but maybe they weren't always that accurate. So here's an example. In 2015, ePhone started with $0 of inventory. We purchased 100 throughout the year, and ending inventory was actually 20. So cost of goods sold, or rather goods available for sale, is 100, right? Ending inventory, if we were accurate in our inventory count, we would have confirmed, yes, we have $20 of inventory. However, our books showed only $10. So something went wrong somewhere, right? We recorded too much of a sale. Maybe we made a sale, a customer made a return, and we forgot to record the return, right? Something happened. So ending inventory is understated. We think our books show $10, actual is 20. The real number is 20. We said, well, cost of goods sold has to be the difference between goods available for sale and ending inventory, which is 100 minus 90, or 100 minus 10 equals 90. It should have been 80. If we were completely accurate, the cost of goods sold should have been 80. So the effect is we recorded $10 too much cost of goods sold. So COGS is overstated. So you can see here, this is just sort of keeping track. Actual inventory is 0, purchases, ending inventory is 20. COGS actually should be 80. The understated inventory results in recording 90, and the difference is 10, positive 10. Positive meaning directionally, because cost of goods sold is an expense, so we're too much debit, right? So what happens next year? If we don't, we don't know about this error or we correct it, right? This is all happening in the background without anybody's knowledge. In 2016, the opening inventory is understated. Again, our opening inventory we're saying is 10, and that's just coming from the ending inventory here, right? So it should be 20, but it's recorded at 10. We purchase an additional $100 of inventory. So our goods available for sale, we're saying is 10 plus 100 equals 110. But it's actually 120, right? And then at the end of the year, we'll say we get everything right. Ending inventory is recorded correctly at 20. Our books show 20, the physical count shows 20, we're good. In this case, our cost of goods sold is recorded at 90. Well, it should have been 100. Why is it recorded at 90? We started with opening inventory of 10. Our purchases were 100, gets us to 110. Our ending was 20. The difference is 90. The actual was we actually had more inventory than we thought. So we actually sold an additional 10 units. Or $10 worth of units. COGS is now understated by 10. Notice how in this year, 2015, COGS was overstated by 10. In the next year, COGS is understated by 10. That's not a coincidence. To the extent your numbers stay the same, these effects will always reverse over 2 years. Now the thing is you have different numbers every year, right? So it's sort of like a rolling calculation. It never really resolves itself. So this just shows how the numbers move, how the ending inventory of 1 year becomes the beginning inventory of the next year. Okay? Note that over the 2-year period, total of COGS is the same under either scenario at 180, right? We booked 90 and 90. The actual was 80 and 100. So over a 2-year period, you're indifferent. You got the right number. But both years are misstated, right? We're talking pretty small numbers here, but if you're a large manufacturing company and your numbers are misstated by $50 million, that's a serious problem, right? Investors might care about that. So here's a multiple choice question. If the 2014 ending inventory is understated, so again, you have to think of, are we talking beginning or ending inventory, and are we talking understated or overstated? Because that'll help you find where you are in your chart, right? It's understated by 3,000. Which of the following is true for 2014 or the current year? So what are our options? Beginning inventory was understated. Cost of sales will be understated. Gross profit will be overstated, or net earnings will be understated. So if we go to our little chart here and we see ending inventory is understated, you see net earnings is understated, minus. If we go back to the options, cost of sales is one option would be cost of sales is understated, which is the same as saying gross profit is overstated. That would be the ending inventory is overstated case, right? But we're actually in this case. So let's try to think about how you could work through this problem without having memorized the solution, right? Ending inventory is understated by $3,000. So just pick a number in your mind, a nice round number, say ending inventory is, in real life, it's 5,000. They counted 2,000, right? The books show 2,000 of ending inventory. That means that we assume we sold an extra 3,000 worth of inventory. When we make a sale, that moves to cost of sales. Cost of sales is therefore going to be artificially higher, and therefore net earnings will be understated. You can't make an assumption about beginning inventory just based on the ending inventory understatement, because beginning inventory could have been fine. There's no way to know, right? Another example, or rather a continuation. So same question, if the 2014 ending inventory is understated by 3,000, which of the following is true for 2015? So now we're thinking about the next year. Okay, so remember what happens to inventory. The ending balance of one year becomes the beginning balance of the next year. If ending inventory is understated, beginning inventory for 2015 is understated. So we know that's correct. In fact, these are all correct, and I'll show you the chart and then we'll go back. If beginning inventory is understated, our cost of goods available for sale are too low, and therefore our cost of sales are too low, and our gross profit and net earnings are too high. Cost of sales will be understated, and therefore gross profit will be overstated, and therefore all the above are correct. Now, it's important to understand the relationship between cost of sales and gross profit, right? Cost of sales is an expense. Gross profit is a profit number. Higher expenses mean lower profit. Lower expenses mean higher profit. So they move inversely. So if you were to see, and this is sort of a trick kind of getting around actually having to calculate something, if I said cost of sales will be understated and gross profit will be understated, and one of the answers was all the above, you know that you can't both have cost of sales being understated and gross profit being understated. So you know by definition that all the above is not correct, right? So you can sort of work out the math that way, but it's important to understand this chart and understand the flow. You could memorize it. Basically, once you sort of memorize cost of sales, you know gross profit and net earnings because they move inversely, and then you know retained earnings. So you kind of know, you can fill in a lot of the pieces once you memorize one or two. You also only need to memorize beginning inventory overstated and ending inventory overstated because beginning inventory understated is just the flip, and ending inventory understated is just the flip, right? Just the reverse. So, all right. Why don't we take a break? I normally don't take a break this early, but this next section is I kind of want to do it continuously. So why don't we just do a 10-minute break? We'll come back at 7:25. Okay.